All right, so we're on our June 22nd, Wednesday, second exam review session. We'll talk a little bit more about financial ratios, and then we'll do a deeper dive in any topic areas, things like inventory, which sometimes gets confusing, or things like receivables and payables, and terms, credits. But the floor will be open. Anything particular on your mind, Keith, that you want to review, talk about? Or you're just trying to rack your brain saying, this has been a marathon. I got a lot of stuff in there. Nothing's shaking. I haven't pulled anything out yet.
That's where I'm at right now, the second option.
Okay, the brain is pretty full. All right, so I'm going to go ahead and share the screen, and we're going to go into that Google Sheet where we're doing the ratio analysis, the ratio calculations. So let's go ahead and pop over to that. And I do think there's our spreadsheet. Nope. Where's the spreadsheet? There's our. Okay, so here is the fifth discussion. By the way, only two discussions left. I'm sorry, three. We've got the video, which is a nice. It's actually a pretty decent video. It's about an hour video, but just some comments on that. You'll meet some students that do what's called a road trip and meet some pretty exceptional accountants who aren't really accountants or aren't doing accounting specifically, but accounting set the stage for their success and a lot of other things. LinkedIn, for over 10 years, I've integrated LinkedIn into all of my classes, from Model United Nations to leadership to financial accounting and career stuff. 5% of my grade every time. I think it's that important, and I think you'll find that valuable. And then there's optional, in an hour and a half to 3 hours, you can get a badge from IBM. Not bad if you're a computer science major and you want to show IBM, which is a pretty recognized name. But it's actually not a bad thing to show on a LinkedIn profile for any major. And these massive open online courses, these MOOCs that are normally free, this is a free one, will give you some exposure. And after completing this, you'll know more about blockchain, which is the basic technology for cryptocurrencies like Bitcoin. You'll know more about blockchain than 95% of anybody else you've interviewed with, talked to, or worked with. So it's kind of interesting stuff. But I'm going to go back to this financial analysis spreadsheet, talk about a few things on there. So I bumped chapter 13 ahead of the curve because I wanted you to have comfort in knowing that, yeah, we do receivables, you get a receivable turnover. We do inventory, you get an inventory turnover. We talk about net income percentage, gross profit percentage, return on assets, return on equity, a bunch of ratios. We talk about horizontal analysis, which is just basically a trend. Last year to this year, what's the percentage change? We talk about vertical analysis, which is a common size statement. So when we say, well, if Walmart sells milk for $2, how much they put in their pocket? We answered that question earlier, less than a dime. Okay, because if they have a 3% net income percentage, 3% of a buck is 3 cents. 3% of $2 is 6 cents. And that doesn't mean the milk costs them, let's see, 6 cents, $1.94. The milk, most likely, the cost of goods sold was maybe $1.50. But they have a bunch of other expenses, that SG&A stuff, selling, general, administrative, and those expenses are also deducted, operational expenses, to get to a bottom line. So just because Walmart is a huge corporation with over $500 billion in sales, doesn't mean they're profitable, but they are. I was actually just talking to a manager at Walmart 2 days ago. He coordinates HR for Wisconsin, Northern Illinois, parts of Iowa, and parts of Michigan. And he was saying last quarter, they actually lost money. First quarter, where during COVID, Walmart's been doing pretty well. They've had higher sales, higher net income as a percentage. They've been doing well, but last quarter they had some challenges. So they don't make money every quarter either. Big bad ExxonMobil oil company. They don't always make money either. But their billions of dollars of net income that they have are big numbers based on the sales they have, which are even bigger. So my point when we do ratio analysis, I'm going to go across this sheet because this stuff is on the exam, but I want you to get comfortable in understanding. If you told me, and Keith, you did tell me this, the current ratio is 4.3 for Inari Medical. And I will say that number is meaningless. And then you're going to say, well, why the heck did you make me calculate it if it's a meaningless number? It doesn't make any sense. The reality is it's meaningless in a standalone sense. If I told you my net income percentage was 4%, you'd say, oh, 4%. Well, actually, that's pretty good for Walmart because they haven't made it 4%. That's pretty lousy if you're Harley Davidson or you're a bank or Apple, because Apple's at 25%, 28%, sometimes 23%. Harley might be at 8, 10, 12%. ExxonMobil might be 7, 8, 9%. So you say, well, here we got 3.54% net income percentage. Would you look at that and say, is that good or bad? Well, it's better than a loss. It's not negative. Some companies lose money. So I don't know if 3.54 is good. I don't know if 4.31 is good. I don't know if 91% is good. I will only know if I look and say, well, last year my net income percentage was 2%. Now it's 3.54%. Oh, wow, that's almost double. That's pretty good. My competitors are at 6% in the same industry, and I'm at 3.54%. Ooh, that's pretty lousy. So you start thinking about the number itself is meaningless, but comparing it to something else gives it meaning. And if it's intra-company with my own company last year, the year before, or within my industry, or just in the general scheme of things, these numbers tell a story. So if my current ratio was 2 last year and it's 4.3 this year, I'm more liquid. My current assets exceed my current liabilities by a whole bunch more. And typically, being more liquid is good. Now, if I asked you if my current ratio is 20 better than 4, is 50 better than 20, is 100 better than 50? The answer should be, it depends, okay? And now the follow-up depends on what? Well, think about it. If you have $100 million in cash and $1 million in accounts payable, those are your only current assets and current liabilities. You now have a current ratio of 100. If you were an investor in that company and you're saying, wait a minute, what are you doing with that $100 million sitting in cash? And I know you're not getting much interest in the bank. And if I, as the company, said, well, actually, I'm going to invest that and buy another company, or I'm buying $80 million worth of machinery, or $90 million worth of real estate, that's a legitimate conversation. If you're saying I'm sitting on $100 million because I'd like to have cash in the bank, well, if you told me you were making less than 1%, which is most likely because banks aren't paying a heck of a lot on cash, I say, I feel like making 1/10% or 0.5%. I'm going to go to a company, take my money and invest it, and somebody's going to make me 5 or 10% returns. 1%, 0.5%, 0.1%. I don't want that. Those aren't the returns I invested in you for. So 100 current ratio is actually pretty lousy, typically. Again, typically 0.8 to 2 is the norm, and especially in a retailer who's a cash business. It's okay if it's under 1, because you're going to cash business. You're getting cash all the time. Allows you to pay bills and buy stuff. And this is that's an annual ratio that you come off a balance sheet. So you look at the number itself is meaningless, but the calculation and a comparison to a prior year lends some meaning. Okay. So I'm going to go over here to net income percentage, 3.54. I don't know if that's good or bad. I know typically high-tech companies in the early stages lose money. So maybe they're making money. That's a great. Or maybe they were made 7% last year and 3.5% this year. Something's going on. That could be pretty bad. So it really depends. Gross profit percentage, again, the function of the industry. What's the gross profit versus net profit versus cost of goods sold? So my gross profit is 90%, cost of goods sold is 10% or 9%. Gross profit 80%, cost of goods sold 20%. Gross profit 48%, 52%, and my cost of goods sold 48%. That makes sense for O'Reilly who's selling auto parts. Facebook cost of goods sold is kind of deceptive. They really don't have inventory as such. Electronic Arts. Again, some of these companies, notice the NAs here. If you don't have inventory, you really can't calculate inventory turnover. Does a bank have inventory? You say, well, kind of. They sell money, but cash is not considered their cost of goods sold. And I mentioned it before. Airlines don't sell you airplanes. Hotels don't sell you hotel rooms. They're renting you a seat on the plane. Hotels are renting you a room. So they really don't have a cost of goods sold. They really don't have an inventory. Even though they call it inventory, I've got 300 rooms available. I've got 75% occupancy. So I've got 75 rooms left. Okay. So you know what? That's their inventory is what they call it, but it's not the accounting in definition of inventory.
Yeah,
thing
that's
with-
what I was. That's what I was going to ask you because I couldn't find inventory anywhere. My dad's real big into stocks. I had to get on his E-Trade account because I was looking everywhere for inventory in the sheets and stuff for the company.
You are so right. Not all companies are going to have inventory. Therefore, you can't calculate some ratios. Not all companies will have cost of goods sold.
That's what I didn't understand though, because my dad works for this company and he goes to hospitals and like puts in these stents and stuff to remove blood clots and stuff. So wouldn't the patient has to pay for the stent and stuff? Wouldn't the stent be considered inventory?
It would, but as a percentage of thing, the stent might be $2
Okay.
and the surgery is 5,000.
Yeah. Okay, that makes sense.
So in the scheme of things, inventory is going to be so small because technically an airline has inventory. They sell food, right?
Mhm.
They're serving food, they serve alcohol on the planes. Technically, a hotel that has a restaurant has inventory too. The restaurant has inventory. But the restaurant in the scheme of things compared to the hotel rentals, the rooms is usually much smaller. So it's not significant that it would show up on a balance sheet.
Okay, that makes sense.
So in the scheme of things, you're right. Everybody does, we have some office supplies.
Mhm.
But the office supplies, we get some pens, paper, and toner. But the office supplies, in the scheme of things, based on the revenues and other expenses, are so small or insignificant that it's not going to show up as inventory on a balance sheet because it's 0.001% or some ridiculously low number. So that's why Facebook really doesn't have inventory. Now you say, wait a minute, doesn't Meta? They actually have some things they do sell. And they might, and Alphabet and Google might have some, like the glasses that they sell that the heads-up display type stuff. Or they may have other hardware that they make available. Or Square, which does that merchant processing stuff, sells these little gadgets that hook onto your phone or your computer. But in the scheme of things, that level of inventory is so small as to be insignificant. All right, so we're looking at this. So we start saying, okay, return on assets. Now, which number is going to be a bigger number? Now, rarely will return on assets and return on equity be equal.
So that's probably not right, but like once again, I did the calculations. I was like, this just doesn't seem right. So I logged into the E-Trade thing and it said both of them were 4.0.
Okay, so that will happen when equity equals 0. So wait, when does equity equal 0? Well, if you're looking at the scheme of things, if I have $100 million percentage here, so let's make this. I'm going to make a bunch of these cells. Numbers. And we're going to go through and so we got $100 million assets. We have liabilities. We have equity. We have net income. So if I have $100 million in assets, $30 million in liabilities, million, and 70 million in equity, and let's say I have $10 million in net income. So how do I calculate return on assets? What are my total assets?
100 million.
100 million, bingo. So if I'm looking for return on assets, I'm calculating ROA, I'm going to have my net income in the numerator, 10 million divided by 100 million. Okay. So I'm going to change this column with all percentages. 10%. All right. My return on equity, though, what's my equity? Well, my
70
return
million.
is going to be the same. Okay. Net income, return, net profit, earnings, they're all the same number. Return is the net income. So I'm going to take my 10 million and this time divide by what for equity?
70.
Yep. It's 10/7. So 14.3%. By the way, since equity is almost always going to be a smaller number than assets, my return equity is almost always going to be larger. So one of my checks when I'm actually eyeballing things, if someone says my return on equity is larger than my return on smaller than my return on assets, I think they might have miscalculated. If they're equal, the only way these would be equal is if my equity was 0. I take it back. Yeah, my return on equity. Okay, let's go the other way around. Let's go 0 debt. And let's go $100 million in equity. The only way my return equity and return assets are going to be the same is when my equity and assets are the same and I have virtually no debt. So if you're telling me they don't have any liabilities, no debt, then their ROA and ROE will be equal.
That doesn't seem to be possible, though. Like everyone has some sort of debt, right?
Not necessarily. They may have they may have $1 billion of equity. They might be a startup. They might be looking for a cure for cancer. They might have 0 revenues, or they might have little revenue, but their return, if they're profitable, they may have no debt. Kodak philosophy used to be no debt. What do you mean no debt? Well, they paid their bills right away, no liabilities. Okay. That's like saying some companies don't have any receivables, like Walmart, like most restaurants, because they're all cash business. Not to say they don't have corporate accounts that do owe them money, or they may have, Sam's Club might have some corporate accounts, but typically a cash business doesn't have any receivables. So you look at these and say, all these numbers are subject to interpretation and subject to analysis. So we go back here and say, okay, my ROA and ROE, all right, NARI is a ticker symbol. Let's do the analysis. Let's go to Edgar. I'm going to pick on you since you did it and you're not sure if you're right. Let's go verify that you're right. So we'll go to Edgar and we'll go to NARI, which is usually NARI is for real estate, but not. Okay, so we'll put in NARI here. In NARI Medical. Going to go to the classic version, upper right-hand corner. That way I can also do filing type here. And if I do 10-K, I get my latest 10Ks. There's only two of them. So they're pretty new company. I'm going to go to interactive data and we'll look at the financial statements. I'm not going to view the Excel document. I'm not going to do the analysis right now. We might do it later. But I'm just going to look at the balance sheet. And if I look down here and my total liabilities are 72, is it in dollars, so 72 million. My total assets are 311 million. So if I have, so you're right, 4% is probably not my return on equity.
Yeah, that's what I thought.
So there's my equity there. I take my net income divided by that is my return on equity. I take my net income divided by total liabilities and equity. That's my return on assets. Now, if we look at last year, we had a much smaller amount of liabilities and we had a little bit smaller equity. So in the scheme of things, there may be some rounding there. It might be 3.8 versus 4.0 and it rounds up to 4% or something. I'm not too worried about it, but I'm glad you looked at that and said, that looks strange when they're the same. How can that be?
Mhm.
And it is strange. And technically, I mean, 4% of this is probably $8 million. 4% of this is $12 million. So they probably, if they had $12 million, 4% here, that'd be 5% here. If I did, 12 million out of 240 is 5%. 12 million out of 311, roughly 4%. So you probably are correct. You probably need to redo the calculation and correct the spreadsheet.
Okay.
Are we on the same page?
Yes, sir.
Sounds good. All right, so let me stop the share here. Well, let me go back to our spreadsheet. Now, I will say, I looked here at Orly, and I actually went into Edgar and said, nah, that calculation's not quite right. They didn't have a 31% net income percentage, which is amazingly high. It's higher than Apple, it's higher than, banks can have 35, 40% net income percentage. Most manufacturers are 5 to 10%. A grocery store, if they have 5% net income percentage, they're jumping for joy because they're typically around 3%, maybe 4% for a Piggly Wiggly or an IGA. But you're looking and saying, okay, well, what's the industry telling me? Well, I'm looking at this, and I'm looking at O'Reilly Auto Parts. They do not have a 31% net income percentage. I can guarantee you that, which is why I put it in red, because I eyeballed it and said, nah, that sounds a little bit high. The 52.7% does not, I don't doubt that. So I didn't check all these numbers, but I eyeballed them. And so you get returns. That's a pretty heavy duty return. Now they may have had a real low equity number. So return on equity could be real high. They might have negative retained earnings. I mean, sometimes companies lose money and their liabilities exceed the assets. So what does that mean? That means I don't have enough assets to pay off my bills, and my equity is negative. This means I've lost some money. Often a company will go bankrupt. They'll have to reorganize. Some will survive. Spectrum, or what used to be Charter, and then they merged with Time Warner. Spectrum had negative equity for a long time, and they didn't close their doors. They didn't go bankrupt. But a lot of companies that are negative equity, that can't pay their bills, usually the debt holders, they reorganize and the debt drops off. Well, we owe $100 million, but we have $50 million in assets. There's no way we're going to pay off that $100 million bucks. So what do? You reorganize, the equity holders get wiped out, anybody who owns the stock, and the debt holders become the new equity holders because they own the company. The company owes them 100 million. They're never going to see the 100 million. They'll say, well, we're going to reorganize it. Now you owe us 50 million, but we got stock. And if we make some profits, we'll get our money back that way. So companies companies make money and lose money all the time. But if you keep losing money long enough, you don't keep your doors open. So we have a debt to equity ratio, and that probably shouldn't be a percent. That should actually just be a ratio. I'm going to go ahead and change that to a new number. Just do number format. Yeah. So some of these are, the debt ratio is debt as a percentage, which is liabilities divided by total assets. And here we go. We had negative, it was negative equity for O'Reilly. So what's going on with O'Reilly? Their debt ratio was over 100%. So their equity might have been minus 1%, and their total liabilities was 101%. So they had negative equity. Not the place you ideally want to be, but it happens. And many companies will recover from that. Inventory turns. How many times in a year does the inventory turn? I'm not sure what 2 out of 14 means, unless it means 1/7, 1 out of 7. But that's usually inventory turns at least once a year, twice a year, 5 times a year, 10 times a year. Okay, so it's not really a percentage. It's how many times the inventory turns. So if I told you I had $100 million in inventory, let's do that right here. inventory of $100 million. And we know that cost of goods sold is usually higher or lower than inventory.
Lower, higher.
Cost of goods sold. Our cost of goods sold, do that little chart thing. Cost of goods sold will keep going up and up and up, right?
Mm-hmm.
Inventory goes up, down, buy, sell, buy, sell, buy, sell, buy, sell. So cost of goods sold is usually a bigger number than inventory because it's cumulative through the year. So I'll go take a look and we'll say, oh, I got maybe 500 million in cost of goods sold. Inventory turnover, we take the bigger number divided by the smaller number. Cost of goods sold over inventory, 500 over 100 is 5 times. Or in the vernacular, I just say 5. So that means my inventory turned over 5 times on the sales cycle. And if I take 365 divided by 5, on average, let's work that to a number. On average, that is 73 days. 365 days divided by 5 is 73 days, just a little over two months, 2.5 months, almost 2.5 months. 73 days. So every 73 days, I sell on my inventory. That's all it's telling me. Now, if I asked you the question, is that good or bad? The proper answer is 2 words. What are those 2 words?
It depends.
It depends. Not 3 words, I don't know. 2 words, it depends. My follow-up asking question is, it depends on what? Well, you say, well, how many days were my inventory last year? Last year it was 80 days. Now I'm 73 days. That's an improvement. My inventory is turning over faster. In the industry, my competitors are at 90 days. I'm at 73. Again, that's normally considered good. But the same way you can have a current ratio that's too big, you can have inventory turnover too fast. You say, well, if 5 times is good, 10 times is better. That's every 36.5 days. But if you're turning over inventory too fast, it either means your inventory number is too small. So if I have limited inventory, it's going to turn over faster. I'm going to have less sales because I'm going to be losing sales on the inventory I don't have. So bigger is not always better. Smaller is not always better. I might ask you the same thing about profit. I say, you know what? My net income percentage last year was 6%. This year it's 10%. And you're going to jump up and down for joy saying, that's great. Rah, rah. We're almost double what we were last year. But how about if you got that way by firing half your staff, cutting down your payroll expense, overworking the remaining employees who all want to quit on you now? That might not be so good. So there is a balance in all this stuff. Bigger is not always better. Smaller is not always better. It really does depend on the situation. But these numbers tell a story. My sales are on the rise. My profits are on the rise. My inventory is on the rise. My receivables are on the rise. Typically, increased receivables as a percentage, a slower turnover. If I get paid every 20 days, that may be good or bad. But if I went from 20 to 30 days, that's probably bad. If I went from 20 to 18 days, that's probably good. But what if I went from 20 to 30 days because the average, say I supply C stores, convenience stores, like the new Buc-ee's here in town. Okay, I sell a whole bunch of stuff to Buc-ee's. If their normal terms are net 30 with all their suppliers, and I'm demanding net 15, I want to get paid faster. But their normal sales cycle is 22, 24 days. They're going to say, Keith, you want to do business with me? You make our terms net 30, and we'll do a whole lot of business. because at net 15, I don't make my money back in time to pay you. I'm going to pay a little bit more from another supplier because they give me net 30 terms. You want net 15? I may still guess I need a backup supplier. I'll probably use it for backup. But I'm not going to buy a whole bunch of stuff. You say, oh, okay, I'll change my terms in net 30. As a matter of fact, I really want more of your business. I'll make them net 40. Can I get more of your business at net 40? And they'll say, yeah. You're going to finance me? You're going to finance my inventory? I don't have to pay you for 40 days. I sell in 22, 24. Sure. That's a win-win. So now I get a whole bunch more business. But now my receivable turnover was slower. I get paid. It takes longer for me to collect. Any company doing business with Ford or GM, their terms are net 180. 6 months to get paid. Do you want to do business with Ford? Maybe, maybe not. That's a business decision. Some folks won't do business with Walmart. They want to be able to say, you know what? I don't want 80% of my business with Walmart, because if Walmart goes down the crapper, I'm not going to have any business and I'm going to have to lay off all my employees. Sears was famous for doing that. You can tell where Sears is now, but what does Sears do? They said, you know what? You guys make washing machines. We're going to buy your washing machines, put the Craftsman name on it, or put the Kenmore name on it, and we're going to sell you washing machines. And you say, hey, I make washing machines. If I can have Sears as a customer, I'm fat and happy. So Sears says, well, what do you want for your washing machine? Oh, we want $300 for our washing machines. Okay, well, we'll pay you $275. And you say, well, it only cost me $220 to make. Sure, let's make washing machines. So you're selling at $275, it's costing you $220, and Sears is selling them for $400, whatever it is. Next year, Sears says, you know what? I want to buy that same washing machine, but I don't want to pay $240. And you're saying, well, I just took out another mortgage, I bought another building, I bought more machinery, I expanded my capacity, and actually it only costs us $210 to make a washing machine now instead of $220. Sure, we'll sell them for $240. And everybody's happy until next year. And then Sears walks in and says, you know what? We only want to pay $210 for that washing machine. And you're saying, well, I just doubled my staff. I've expanded my business. I bought more machinery. It cost me $210. I'm getting things down to the bone. I can't get much more out of that. And Sears says, well, do you want to do business or not? So what do you do as a company? We find a way to make it for $200 instead of $205 or $210. And we do business with Sears that year. Until the next year, Sears walks in the door and says, we want to pay $190. And you're saying, we just trimmed this to the bone. We are at $200. That's as low as we can go. Every one we're going to sell, we're going to lose money. And they're saying, figure it out. And now you have a choice. Do you figure it out, or do you stop doing business with Sears? There's a really good book out there called The Walmart Effect. And I don't know if you remember the age when females or males used to buy deodorant. It used to be wrapped in cardboard and plastic with bottom line, it was $6 with $4 worth of packaging and $2 worth of deodorant. Now, what did Walmart do? They said, we need to get the price down. And they work with their suppliers and says, you know what? We can make these sticks with a little gadget at the bottom that drives, the bar up on your deodorant. And we can stack a whole bunch of them. You don't have to package them. You don't have to do any fancy packaging. You just got this plastic casing that people can turn the knob and get more deodorant. So instead of charging $6, they're able to charge $3. That's the Walmart effect. They help you get the prices down. Everybody wins. And now in the pharmacies that you buy your deodorant, it's cheaper. You go any other department store, it's cheaper because they're not packaging with all this fancy stuff. Walmart gets a bum rap with a lot of folks, but they have made things a lot more efficient for a lot of folks because they force that creativity. How do we get the price down? How do we supply the customers at the best value? And then
doesn't that often decrease like the quality sometimes? Like not necessarily with deodorant, but like when you're mass producing stuff and trying to make it like easier and stuff.
Two words. It depends.
Yeah.
Okay, it depends on what. Are you being more efficient? Or is it cheaper ingredients? Is it a cheaper product? Maybe China gets a bum rap too, but they're a lot cheaper because their labor is cheaper, and they do some funky things sometimes. They add things that shouldn't be added, and they get it really cheap for some of the products they make. Okay, and they'll dump steel or aluminum in the U.S. at below cost. We that happened in the 80s with Japan. When I went to business school, the answers to the country that XYZ, the country name was Japan. The company that XYZ, the company was GM. Nowadays, you say the country that ABC is China. The company that ABC is Walmart. Because they're the big players, they're the large companies, they're the large countries that have the impact. But in Japan, they were selling at below cost. Why did we not make TV sets here in the US? Because Japan was dumping TV sets at cost below what it cost us to manufacture, Magnavox, whoever the companies were in the States, and those companies went out of business. So once they went out of business, Japan said, oh, we can raise our prices because we got the market now. It's a monopoly. We got a captive market, and there's no competition in the US for those products. So that was pretty effective at adversely affecting US industries. Now there's a big push from manufacturing at home. That's a different story. But the whole point is, to answer your short question with a long answer, I guess I'm an academic, so I make long answers. But you get the point is that it can be more efficient and more effective and cheaper for all concerned, or it could just be cheaper and less quality. But it could still be cheaper and more quality. It could be more pure. It could have less impurities. It can last longer. It could be vacuum sealed, so it has a longer shelf life. It has more chemicals, so it preserves longer. Who knows what the changes are? Not all changes good, not all changes bad. But if we can make the assembly line and Ford can make a car cheaper, I mean, when Ford doubled the wages of all their employees in manufacturing, Henry Ford upset a lot of his competitors and a lot of other manufacturers because he was paying a much higher wage for manufacturing than competitors and other businesses. Why did he do that? He wanted everyone to be able to afford a Model T, including his employees. $700, $800. The only way he could do that if they were making enough money to eat, live, sleep, and buy a car. So he had to give them enough wages that they could buy cars too. And affected the economy. I mean, that's the whole scheme of things. So let's look at some of these other return equity, return on assets, debt to equity, inventory turnover, receivable turnover. And then we look at cash. Let's see.
Yeah, I just couldn't find any of that stuff. I'm sorry.
No, that you know what? Well, actually, percentage change in sales. You should be able to do that.
Yeah.
Okay, if I had 2021 sales of 100 million and 2022 sales of 120 million, you basically take current year minus prior year divided by prior year. So you should be able to take your two sales numbers. So in this case, I'd have 120 minus 100 divided by 100. So I'd have 20 over 100, which yields 20%.
Okay.
So I had a 20% increase from last year to this year. Nothing fancy. Is that good? Is a 20% jump in sales good?
I guess it probably depends.
It depends. Good answer. I like that. Depends on what? Well, if I'm a high-tech company and I was expecting 50% increase in sales, 100% increase in sales, doubling of sales, 200%, this is lousy. But if I'm in a mature industry and my competitors are pretty steady state, maybe they had drop in sales because of COVID or a slight increase of 2%, 5%, and my sales are up 20%, again, I'm jumping for joy. And then you say, well, let's look at my net income percentage change. My sales, if my sales went from 120 to 100 and my net income, let's do a sales here. And my net income went from, well, to the bottom line, I just raised prices. My cost didn't change. I just raised prices. So I went from 25 million in profits. Let's just do it right, 25 million. And I jumped to 45 million. Okay. Let's go 20 to 40. Make the numbers easier. So I went from 20 million in profits straight to my bottom line. And I went to 40 million in profits. Well, what was the change? Well, I went 40 minus 20 is 20, the numerator, 20 the denominator. That's a 100% increase in profits. So 100% increase based on a 20% increase in sales. That's cool. So and sometimes net income goes down. I increase my marketing budget. Sales is up, but my marketing hasn't paid off yet. I bought a couple of Super Bowl ads, whatever it might be. Maybe my sales went down, but my profits went up because I became more efficient. Let me ask you a question. Does your stock price go up or down if you lay off 10% of your employees?
I would think it would go down.
Okay. 2-word answer.
It depends.
It depends. Good answer. I like that answer. Depends on what? Well, if the market expectation is I'd cut my labor force by 10% and I'm going to double my profits, investors might say, you know what? That's going to increase my return on assets, my return on equity, my return on investment. Yeah, that's actually a good thing. I'm more efficient. I had a bunch of dead weight in there. I'm more efficient as a company. Investors might say that's a good thing. But if you're laying off employees because, well, we're kind of scrambling, our profits are in the toilet, and we need to lay off some employees just to break even, just to get some minimum profits. We're struggling as a company. That's why we laid off people. That's probably a bad thing. So stock prices probably go down. It's all based on anticipation. It's on the markets, how they feel. Are we making sense?
Yes, sir.
All right, so let's go over and then you go to stock price. And then you start talking stock splits, Apple, Tesla. Okay, you're looking at companies, Amazon, 10-for-1 stock split. $2,000 share is now worth 200, but you own 10 of them now. And Amazon shares have been going down as of late. Actually, I could say any company on the stock exchange right now with 98% accuracy, I can say it went down, and I'd be right because the market's really tanking, as you know. More than 20% decrease, which is considered a bear market as opposed to a bull market. So, and market's down over 20%, both the NASDAQ and Standard & Poor's and the Dow. They're all down. And then we look over here, just as a fiscal year end. The only auditor that's not a Big Four auditor here, we've got KPMG, we've got Deloitte, we have EY, we got PwC, and then that's kind of cool that all the Big Four are represented. But then there's one company called BDO Seidman, it used to be called. They're not Big Four. They're a second-tier firm like Grant Thornton, where I was also working one time. And you look at that and say, wait a minute, this is for Inari Medical. Inari Medical is probably not a Fortune 500 company. By the way, Inari Medical, do you have a relationship with the company?
Yes, sir. My dad works there.
Okay, so you have some familiarity. How long has you worked there?
Just started this December.
Okay, in sales or what aspect?
Yeah, he just local the PD and Grand Strand area and implants these stents and stuff with doctors and removes blood clots and stuff.
Cool. So and they sell globally?
I believe so. I think he had his national sales meeting a couple of weeks ago, and there's only like maybe 300 at most people in the whole company. I think it founded in maybe 2018, 2019. That's probably wrong.
2 years publicly traded.
Yeah.
They probably just went public 2 years ago. They're probably privately held. I wonder, hopefully he's getting some stock options.
Yes.
Is Inari, I'm just trying to think out loud. Are they based here in Florence, or where's corporate headquarters?
No, I think it's Los Angeles,
All right.
somewhere in California.
Okay, so it could be San Francisco, LA, high tech, possibly, medical field. Okay, cool. I was just talking to a guy from Merck Sharp and Dome, Merck today. I grew up with him in Randolph, Massachusetts. Re-met him in Madison, Wisconsin, where I lived for 30 years. He ended up moving to the West Coast. He's out of Portland right now, but he retired 5 years ago. So he worked for Merck for 35 years. And so we had a pretty conversation about big pharma and medical stuff going on. But I
Yeah,
hadn't
sure.
talked to him for over 20 years. It was kind of neat, kind of interesting.
Yeah,
Anyway,
my dad used to work for Boston Scientific,
oh,
which
excellent.
is yeah,
I know about
it's
that.
very similar. Yeah,
Excellent. So basically medical devices, medical supplies
yeah,
for
sure.
surgery and for for some of the high tech stuff they design. Very cool. So you got to know a lot more about the company than your dad might know right now.
Yeah, yeah, sure.
Did you share your findings with him?
Yeah, I tried to.
I go
Yeah.
back and, this percentage change is an easy calculation.
Okay.
This year minus
I
last
was
year divided by last year.
Yeah, so I was watching your video from the Zoom last Wednesday to try to like find the stuff, but I don't know. I don't know if it's because I have an Apple computer, but it was the website. I can't remember what it's called now. That we had to find this stuff through that thing. The format was different on my computer than it was on yours.
Okay, so I'm going to go to Edgar. I'm going to go view Excel document right here. Okay, this is the company you were looking at. And it's going to download my Excel document. I'm going to open the file. I'm going to go ahead and access it. That's a reconciliation for my Pakistani business partner. But I want to go into your company and enable editing. So now I'm going to go into, I go down the bottom here. Actually, got to get this out of the way. Okay, so I got a consolidated balance sheet. We just looked at a balance sheet. And I'm going to go over, to statement of operations. This is my income statement. Okay. So if I want to create a column here, and very quickly say, okay, equals, and paren that minus that, close parentheses, slash that, the most recent one, the older one. I'm going to make this a percentage. And let's go into, all right. So I'm going to copy this formula right on down. So I just calculated 98.3% increase, almost 100%, which looks there, 140 to 280. That's almost doubling of revenue. So they went from 139 million to 277 million. I copy that formula down. I've got all my percentages that I fit to print. So what happened? Net income was down 28%. I went from 13.8 million down to 9.8 million. So my sales were up almost 100%, but my net income or profits were down almost 29%. Nothing fancy about the calculation I just did. But it's just a trend analysis, horizontal analysis. And you're saying, well, wait a minute, they spent a whole bunch more on R&D, from 20 million to 30 million. If they kept their R&D spending at the same, that 30 million would have gone to my bottom line. I'd be at 39 million. I would be almost triple net income. Oops, there we go. Net income loss. Yeah, I'd be triple. But I put more in R&D, which means my future products that I make, I hopefully will sell more. My SG&A, I must have hired a bunch of people like your dad. Okay, I went from 90 million to 190 million. Selling expenses, general expenses, administration, payroll. So my total operating expenses more than doubled. Income from operations is down. By the way, my revenues went up 98%. My cost of goods sold only went up 89%. So I've got a little bit more margin there. So these numbers are telling a story. The reason we do this financial analysis stuff is to extract that story. Is to learn about what's going on. What do the numbers tell us? Are they spending too much in R&D? Maybe not, because that's probably a strategic decision. Because I think about it, we spent 20 million out of 140 on R&D. We're spending 50 million out of 275 on R&D. That's a pretty big ticket. That's like 20% of our revenues are going towards R&D, research and development, for new products or enhancing existing products. What are my competitors doing? If I spend zero in R&D, this 50 million will go to my bottom line. But how's that going to affect my sales 2 years from now if I don't have new products? Does that make some sense?
Yeah, sure.
So again, this is a story that the numbers are telling us. It's not a good story. It's not a bad story. It's just the reality of what the numbers are telling us. So when we look at those numbers, we can, and you've got an inside scoop because you got your dad who works there and says, hey, I'm selling a whole bunch more. That's covering your tuition, son. I'm doing a lot better this year. You're not going to have any debt when you graduate, okay? So I mean, you get the idea. Though. So when you look at that, saying, okay, their profits are down, but their sales are up. And actually, I'm going to go back here for a second. And even though I go down here, my profits are down from 14 million to 9.5 million. My sales are really up 140. If I was doing vertical analysis, okay, so let's now insert a couple of columns and do that vertical thing again. This is a horizontal. I'm going to do a vertical analysis. Again, you can do this really quick. Equals that slash that. And you're right, I did this in the demonstration on the spreadsheet that we did. And what's cool is, I'm just going to make this a number. All right. So this form, keep $B, $4, absolute referencing. I'm going to copy this down. So if I look at this, my net income percentage is 4%. Actually, let's just go one more decimal. We'll make this a percentage. Yeah, decimal. Now, if I do the same thing here, copy this down. So here's my vertical analysis. And I'm going to do this as a percentage again. Okay. So I look at this and I say, well, my cost of goods sold went from 9.4% to 8.9%, and my gross profit went from 90% to 91%. So a vertical analysis says for every dollar worth of sales, the stints cost me 8.9 cents, and I made 91.1 cents on every stint I sold on average, or whatever other products I sold. Now I look down here and I'm start saying, okay, there's some trends. I'm at almost 10% net income percentage. I'm only at 3.5%, even though I just dropped 4 million. But I'm down as a percentage, much smaller because my total sales number is a lot bigger. So again, we got the story being told here. Okay, so income from operations is down to there's 3.9 versus 13.2. So again, this is that dollar of sales, how it pans out for everything else. So that's the big picture and why we do these analyses and all this ratio stuff, this horizontal trend analysis, this vertical or common size analysis. Because it tells a story. And we want to understand the story of what this company is doing and how it's doing it. Are we on the same page?
Yes, sir.
Was this helpful at all? Was it kind of gives you
Yes, sir. Very helpful.
additional insight? Okay, good. So I'm glad you're here. Other questions you have in anything else, be it inventory, receivables, payables, anything that might be on the exam that you want to talk about?
I can't really think of anything off the top of my head.
Well, my door is open if you want to chat. If you just don't open the exam and call me and say, how do you do this? But
Yes, sir.
otherwise,
I'll try not to.
but if you have some questions before you take the exam or you're viewing something and you get some questions like, where did this come from? I'm happy to talk about it and work together.